Now, there's somebody that I want to bring to the stage with me that I know doesn't need an introduction. Ladies and gentlemen, please welcome Bruce Norris to the stage. Love you, brother.
Thank you.
So if we can, I want to start getting into the 6 comps that you've historically always looked at. One is median price, whether it's California, wherever it is. As I'm going through these, until we get to the moodometer, the top factor of why you picked these as a 6 comp. We look at median price, then we got affordability.
Affordability was key because there was a repetitive ending point. When I recognize that, and it's usually when you're euphoric about real estate, all of a sudden you can go, well, it's about over. Everybody loves it, but it's about over. And the opposite is true when it's down in the bottom. Everybody's afraid of it. And if you're smart, you can go, maybe I should want that at that time.
Now you're starting to compare things. You got historical new home price versus existing.
Yeah.
Why is that a major comp for you to look at?
What it taught me was there's only a few times that the intersection happens where the existing home is more expensive than the new home. The new home builder didn't build enough to meet the demand, so the demand flew to the existing home. And they overpaid for that because there wasn't anything else to buy. They wanted it bad enough. So that's what typically happened. And once that happens, you know you're toward the end of the cycle. You're euphoric, but that's got to end because it's never continued.
One of the questions that we got a lot on this, and I want to just touch here quickly though, when you're looking at this chart in particular, this metric, are you looking at where things are moving, or do you study where the inversion of those curves hit?
Yes, that's the most meaningful thing. It doesn't matter to me that there's a repetitive inversion. It matters that it goes through the whole cycle where the spread begins again, to where I know that has a meaningful ending again. So you could be 10 years away from that being a meaningful chart, but when it crosses, it's meaningful. It doesn't matter how big the spread gets, by the way.
At the time when you started creating this, you're only looking primarily at California. Right. Why were you comparing California to the U.S.?
Well, again, it was sort of like you're looking for all the evidence. So this chart didn't probably start in the first 2 or 3 reports. So as you grow, you're thinking, okay, is there any connection? You know, there's usually a spread, a percentage of value. California is more expensive than the nation always, but when does it get to the ridiculous? So when it gets to the ridiculous, what happens is we say, well, maybe we'll sell our stuff and go to Idaho, where, gosh, I can buy 2 houses when I sell mine. And so that starts to happen. So the bigger the spread, you have it exiting where California goes, this is so great. I can go do what I want and pay for it in cash. So that's what was the significance of this chart, that when that starts to happen, then you have people selling, but you also have it go back to somewhat of a normal number.